This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on swing trading and scalping. In this video, I want to define what I mean by swing trading and what I mean by scalping. A swing trade in general is any trade where you're going for a reward that is at least twice as big as your risk. I think swing traders have a different personality from scalpers, although scalpers sometimes swing part of their trade and swing traders sometimes scalp. In general, I think it's 2 different mindsets. I think the vast majority of profitable traders are swing traders. It takes a very special and unusual personality to be a successful scalper. Most traders should not be scalping. We have a good bull breakout, 4 consecutive bull bars, 3 good-sized bars closing on their highs. This is a reasonable buy for both a scalper and for a swing trader. If they buy, they could put a stop right below the low of this bar. It's a second entry buy, leg 1, pullback leg 2. The first leg has a reasonable buy here and here as well, but this is a second attempt at trend resumption up, and it's around a 50% pullback. The initial risk is to below the bottom of the signal bar, and the traders buy just above the high of the signal bar. So they get in here, their initial risk is here. It's a fairly high probability trade, and therefore traders have a positive trader's equation if they exit with a reward simply equal to their risk. A scalper buying here, stop here, can then get out here, a reward equal to his risk, and have a positive trader's equation. Some scalpers might hold hoping for more, and some of those scalpers will then get out on a reversal down below the low of this bar, and they'll get out right here. They're concerned, maybe we got a double top, lower high, and a swing down. A scalper wants high probability of a profit, and that means a quick profit, and they do not want pullbacks, or they only want brief pullbacks. In return, they're willing to accept small reward. Any trader who wants a high probability trade is going to be taking a small profit. That is the trade-off. There always has to be a reason for an institution to take the other side of the trade. If you get high probability, you get small reward and generally relatively big risk. In other words, a bad risk-reward ratio. In general, a scalper needs a probability of 60 to 90% that the market is going to reach his reward before it hits his stop. Also in general, the reward is about the same size as the risk. In other words, a risk-reward ratio of 1, which is not very good. Most traders need to be going for a reward that is at least twice as big as their risk if they're going to be consistently profitable. The scalper gets out here. The swing trader holds on to his trade until the premise is no longer valid. For example, until there's a reasonable reason for bears to take a short. Possible final flag, the biggest bull bar, 20 or more bars into the trend, probably a climactic end to the trend, a bear bar closing on its low. This is a reasonable location to exit longs, thinking that either the market's going to enter a bear trend or it's going to go sideways and evolve into a trading range. The premise of a bull trend is now much lower, so it's reasonable for a swing trader to get out here. If he does, his reward is many times bigger than his initial risk. A scalper will often trade a minor reversal if he thinks the reversal will be far enough down for him to make a profit. It has to be at least the minimum scalp size, and if he thinks the probability is high enough to offset the risk. Remember, a minor reversal means that the trend is likely to continue or at least evolve into a trading range and not become an opposite trend. A minor reversal is small, and a scalper only needs a small profit. The scalper will often trade against a trend if he thinks the minor reversal will be at least big enough for a minimum scalp. For example, here we have a series of buy climaxes here, here, and then 2 bars here, and then here. And this is a very big bar, breaking above the top of the bull channel. A scalper will often sell below the low of that bear bar. It's a decent bear bar closing near its low, looking for at least a test of the bottom of the most recent buy climax bar. He'll take that short as long as the distance between his entry price and that bottom of the buy climax bar is at least as big as a minimum scalp. and if he thinks the probability is high enough to offset the risk. Bulls and bears expect a couple legs down after a parabolic buy climax. It's also up to around a measured move up from this low to this high. We have a bull breakout here. However, they also expect the bull trend to resume after the pullback, either to here or to here, and therefore the reversal is minor. The bear who takes that short typically would put his stop above the bear bar. The top of the bull trend is only a little bit higher. He could put his stop above the top of the bull trend as well. He's looking for the market to test the bottom of the final buy climax bar, the biggest bar in the trend, the breakout above the bull channel. He'll take his profit there. A swing trader will often hold on to his position despite minor reversals, because a minor reversal by definition means that the trend has not changed. The trend is likely to resume. For example, here we have a bull bar, another bull bar, and then we have a pair of bull bars breaking above a trading range, and we have a bull follow-through bar. A lot of bulls will buy that close, expecting that even if we reverse down here, there'll be at least a second leg up. If he buys here and it pulls back, he can buy more here. It'll test back up here. He can get out break even on his first entry and with a profit on his second entry. We have a pullback. It started after one more bar. A bull breakout of a bull channel and a decent reversal bar. It's probably going to pull back for a couple legs. One, pullback, two. Tight channel. It could be the first of a more complex pullback. One, pullback, two. In any case, any bull buying here believes this is a minor reversal and that either the reversal down will lead to a trading range, which it did for about 30 or 40 bars, or a resumption of the bull trend, and therefore he's willing to buy, not exit on the minor reversal, and simply rely on his stop. Again, a minor reversal means that it'll be a pullback, in other words, a bull flag, or at worst, a trading range. In either case, he can avoid a loss by scaling in. Even if he had bought this high close right here, he could rely on his stop and then buy more either above this bull bar or above this bull bar. And then when it gets back up to his original entry price, had he bought the high close, he could get out break even on his first entry and with a profit on his lower entry. Here, late in the session, we have another reversal. However, the bulls are losing momentum. We're getting a lot of doji bars. A horizontal trading range late in a bull trend often becomes the final bull flag. We have the biggest bull bar occurring more than 20 bars into a bull trend. Here we have the biggest bull bar in about 50 bars. It's probably an exhaustive end to the trend. And it's also a nested wedge. Different ways to count the three pushes. 1, 2, 3. 1, 2, 3. Therefore, this has a pretty good chance of being a major reversal, leading either to a trading range or an opposite trend. It's a good location for the bulls to exit. Minor reversal, many bulls will hold long if they buy here. Major reversal, the bulls will exit and bears will start to short. When there's a major reversal, traders expect either a bear trend or a trading range. A minor reversal in a bull trend, traders expect either a bull flag and trend resumption or a pullback and a trading range. Some swing traders will exit when there's a minor reversal if they think the minor reversal might in fact become a major reversal. For example, let's say a bull bought the follow-through bar from this breakout, and then he sees an even bigger bar breaking above the top of a bull channel, and he sees that it's around a measured move up from this low to the top of what was a bear flag. We broke strongly above, and we went up to about a measured move, and then the market's reversing down. This might become a large trading range, and it could test all the way down to the bottom here. Some swing traders who buy here will exit here, knowing that it's probably going to either be a trading range or a bull flag, but they take that exit if they're willing to buy again when they think the bull trend is resuming up. For example, they might buy above this bull bar, high 1, high 2, or after a bigger test down to around a 50% pullback above a bull bar. This is where the always in bulls buy again. This is not enough to make it always in short, and therefore it's always in long. It's around a 50% pullback. It's testing the breakout point above this bear flag. It's a reasonable place to get long. The bulls who bought again here will exit up here toward the end of the session after a possible major trend reversal. Again, a bull who bought for any reason during this bull trend can rely on his stop, betting that the first reversal down will be minor and there'll be at least a small second leg up. Or he could exit on a reversal that he thinks might be major and then look to buy again on a resumption of the bull trend. I talked about several ways to distinguish whether a trade is a swing trade or a scalp. An important way is how a trader plans to manage the trade when he puts the trade on. If he's planning to manage it like a swing trade, and he holds on through minor reversals, he holds on for 10 bars, 20 bars, 30 bars, even if his profit is less than 2 times his initial risk or his actual risk, it's still a swing trade. If he's managing it like a swing trade, whether or not it's profitable at all, it's still a swing trade. For example, let's say a trader looks at this breakout and concludes it's very strong, and the first reversal down will probably be minor. He goes ahead and he buys the close of this bar. He knows its consecutive buy climaxes here, 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 and here. However, he assumes that any reversal down will be minor and become either a bull flag or a trading range, and therefore he's willing to buy and put a stop below the bottom of the bull trend. There's something special about this particular setup. It's a very strong breakout. Whenever you have a very strong breakout like this, there's a 60% chance that the market will rally for a measured move up from the open of the first bar to the close of the final bar of the breakout. Traders will often put a stop below the bottom of the breakout rather than all the way down below the bottom of the bull trend. This is reasonable. Whenever you use a tighter stop like this, the probability of success is less, but it's still, in this particular case, 60%. A very strong bull breakout, a series of bull bars. The market has a 60% chance of continuing up for a measured move based upon the open of the first bar to the close of the final bar, which would be somewhere up here, even if there is a pretty big pullback in between. If the market goes straight up here in just one bar and he exits, is it a scalp or a swing? Well, the reward is probably many times greater than the size of a minimum scalp, and therefore I would call it a swing. He went for a profit that would have been many times bigger than the actual risk, and I would call that a swing. So for example, if he buys here and it just goes straight up here, his actual risk would have been very tiny, and his reward would have been very big relative to that risk. That would be a swing. Even though he'd be exiting in only one bar, which is what a scalper does, he would be getting a swing trader's profit, and he had the intention to hold for many, many bars with the goal of reaching that measured move target. Look what took place up here. The trader held his trade for about 50 bars. He held through a fairly deep pullback, a 50% pullback, a minor reversal though. And now we have a potential final bull flag right below the target. It's fairly common when the market gets near an important target for the market to turn down before it gets to the target. Because this is a possible major trend reversal, a wedge, 1, 2, 3, or 1, 2, 3, a final flag, and the biggest bull bar more than 20 bars into the trend. In fact, this bull bar is bigger than all the bull bars for maybe 50 or 60 bars. Therefore, very likely to be an exhaustion bar. It's reasonable to get out here. Some swing traders will continue to hold with their stop below the most recent major high or low, with the intention of getting out near their goal. When you're this close to the goal, do you really want to continue to use a stop down here? I think most swing traders would not risk this much to make this little profit. However, it's reasonable to do. Instead, they would exit here, wait for a couple legs down, and then buy again above a bull bar here, looking for a test of this high or the market reaching the target. When the probability is high like this, 60% or more, traders do not need a reward equal to 2 times their risk to make a positive trader's equation. All they need is a reward equal to their risk. The trader who bought here, even though he's exiting with a reward 1 times his initial risk, if he put his stop here, he intended to hold for many bars. He intended to hold through minor reversals. He did here, 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 and he either got out here or he held all the way here. He was planning to manage the trade as a swing trade. He did manage it as a swing trade, and therefore it is a swing trade, even though the market did not reach a reward equal to 2 times his initial risk. His actual risk was below the low of this bar. If he bought here, the market turned down to here and went all the way up there. The most he needed to stay in the trade, in hindsight, was a stop right here. So he actually only risked from his entry price to just below the low of this bar. And this reward, I don't know if it's twice actual risk. Here's his entry price. Here's his actual risk. It's not quite twice his actual risk, but it doesn't matter. Traders would still call this a swing because he held for a lot of bars and he held through several minor reversals. Again, actual risk is just below the low of the deepest pullback after you entered the trade. The bear is trying to get a reversal, but it's a higher low, and it's a breakout test of this high. The bears have a bear reversal and a follow-through bar, but bad follow-through here, and now there's a micro double bottom with another bull bar. This is a reasonable buy for a swing trader, betting that the bear reversal will fail and that the bull trend will resume. However, this is a strong enough reversal down with bear follow-through and a reasonable top, maybe a wedge, 1, 2, 3, maybe a final flag, and then an exhaustive buy climax, trapped bulls who bought above that bull bar. The probability of this trade is much less than the probability here. This has a much higher risk of the bull trend no longer being in effect. The market might now be in a trading range. We might get leg 1, pullback leg 2. It might also be in a bear trend, bear spike, pullback, and channel. The probability here is less than the probability there. You're also buying at the top of a tight trading range, and breakouts tend to fail. So again, the probability is lower, buying here. Yet, if you do buy here, you're hoping that the double bottom holds, that the market does not fall below the double bottom. It's reasonable to place a stop below the double bottom. Because it's a lower probability trade, a trader needs to compensate with good risk reward. So a trader buying here with a stop here has to be planning to exit with a reward that is at least twice as big as his risk. He buys above this bear bar or above that bull bar. But let's say he buys above this bear bar. He gets filled right here. His initial stop is here. This is 1 times his risk, and this is 2 times his risk. A reasonable location to take profits, especially since it's near the top of a possible developing trading range. Low probability trade, traders should go for a reward that is at least twice as big as their risk. They need a good risk-reward ratio to offset the low probability. Without that, you are not structuring a profitable trade. In other words, the trader's equation is not positive, and therefore you are not likely to make a profit. I have general guidelines that I use when I define what a swing trade is. For example, in the E-mini, if I'm swing trading, I'm going for a reward that is at least 4 points. If I'm trading in the Forex markets, I'm going for a reward that is at least 40 pips. If I'm trading stocks and it's a $100 stock, my minimum goal for a swing trade is at least 50 cents. When a swing trader takes a trade, he's hoping for a trend. And remember, a trend is a swing that covers at least half the bars on the screen. The minimum goal is 2 legs and 10 bars, but most swing traders are expecting at least 20 bars, and that is about 2 hours on a 5-minute chart. Also, the reward should be at least twice as big as the risk. It often is many times bigger. It's common for traders to take a trade and they're not sure if the profit will be a big scalp or a small swing. Most traders should only be taking trades if they feel like they can take it for a swing trade. These are all reasonable swing entries. We have a 2-bar bull breakout closing on its high after a series of other bull bars. Reasonable to buy here, buy the close, reasonable to buy here, high 1 buy, high 2 buy, reasonable to buy. More complex high 2, high 1, pullback, high 2. All are reasonable swing trades, and it's reasonable to use the same stop, either below the bottom of this buy climax or the bottom of the bull trend. The minimum reward for any one of those entries is based upon the distance to the stop. For example, you could buy here, stop down here, betting on a buy the close bull trend. If you buy here, stop here, 1 times risk is right here. It's reasonable to exit here because you're taking a high probability trade. If you're going for a swing instead, 2 times risk is up here. And you can see there was some profit taking here. This is where scalpers would get out. This is where swing traders would at least take partial profits. A scalp means that you're going for a reward that is less than twice your risk. Most scalpers take profits within 1 to 5 bars, and they prefer that the market not pull back, not reverse. For example, a trader might sell below the low of this bear bar and then scalp out. A trader might buy above this bull inside bar, betting on a little bit more up. A trader might buy this close. A trader might buy here. A trader might buy below that doji bar, betting after 5 bars up, there'll be buyers below. Here we have a bull II and a bull trend, so a trader might buy above that small bull bar, and they might buy this close after a bull breakout bar. You could buy below this bear bar, even though it's 3 pushes up, 1, 2, 3, it's about a 15 bar or 10 bar bull microchannel. The odds are the first reversal down will fail and will become a bull flag. Or you can buy above this inside bar. It's a small high 2, high 1, high 2. Or you could also call it a wedge bull flag for trend resumption up. And we have a strong bear breakout and strong bear follow through. Probably you'll get at least a small second leg down. A scalper will sell the high of this bear bar and get filled right here. This looks pretty easy to do, but it's really not. And beginners should not be scalping. And most experienced traders prefer not to scalp because it's hard to do and it doesn't suit their personality. Any scalp is a reasonable swing trade. And all of these are reasonable scalps, and they're also reasonable swing trades. Even selling here is a reasonable swing trade, although it turned into a loser. If you are scalping, it's easier to make money if you can use a swing stop and scale in. For example, if you're scalping, and let's say you bought here, it's better if you're able to use a stop down here or down here, and then buy more lower. For example, the size of a scalp lower, or the size of 2 scalps lower, or on a reversal up, as long as this entry is at least as big as a scalp below your first entry. The traders who do buy here and buy more here will often try to get out break even around their first entry, and then with a scalp on their second entry. Therefore, they want that second entry to be at least the size of a scalp below their first. If you are a scalper and you're using a wide stop and you're scaling in lower, it increases your probability of success, but it also increases your risk. You therefore have to be trading a very small position, at least initially, and you have to have the temperament that allows you to have a trade go against you. For example, if you buy here, are you able to hold long when the market is doing this, relying on your stop here or here? If you're not, if it causes too much stress, you cannot be doing that long term. That's not a career type of trade for you, and therefore you should not be taking that trade, at least not for a scalp. A swing trader would be much more comfortable buying here and putting a stop here or here, trusting that the odds are the market's going to have a second leg up. A scalper, on the other hand, is going for a very small profit, and he's very concerned about a risk that becomes greater than his reward. If you're unable to trade that comfortably, if you have too much stress, you cannot be doing that type of trade. And that is one of the main reasons why most traders should not be scalping as their primary source of income. It's just too hard to do emotionally. It's not fun for most traders. Most traders do not like to do it. It's too stressful. When the market's clearly always in long, and it is all the way up here, a swing trader can buy at any time and for any reason. However, he has to use the correct stop, and the correct stop is always below the bottom of the most recent strong leg up. In other words, the most recent higher low. Here we have a higher low, not yet a major higher low, but after you start to get a strong rally, especially a rally to a new high, this becomes a major higher low. No matter where you bought and for whatever reason you bought, once the market is up here, traders will put their stop here. If it was here or here initially, they'll trail it, they'll move it up to here. And the same here. No matter what reason you use to buy, all through here, once you have a strong breakout, traders will see this as a major higher low, and they'll move their stop here. If you're buying anywhere in here, once the market is here, traders are going to tighten their stop to either here, the bottom of the most recent breakout, or the bottom of the most recent leg up. Swing traders are going for a reward that is at least twice as big as their risk, and they allow pullbacks. For example, if you buy here, the market pulls back further, you're still holding on to your position. Even though this is a pretty good bull bar and the market fell below it, swing traders will still hold long because their stop is probably down here. They allow pullbacks, and they expect to hold on to the trade for at least 10 bars. Most swings last at least 20 bars, and therefore swing traders are willing to hold for a long time through a lot of pullbacks. If you're holding on to a trade that's going to last 20 or 30 bars, you're going to have pullbacks, and some of them are going to be pretty big, for example, like this. After every strong breakout to a new high, traders tighten their stops. The market goes up here, you raise the stop to here. Whether it was here or here, you raise it to here. Now we have a strong breakout here. The stop is now here or here. That's called trailing your stop. Scalpers can only take a trade if they believe the probability is 60% or greater. And they want that probability to be 60% without scaling in. They're willing to scale in, but when they take the trade initially, they believe they're taking a high probability trade, a trade that has a probability of at least 60%. These are reasonable trades. Buying here, 60% chance the market is going to go up for a reward equal to the risk. Buying here, 60% chance it's going to go up at least as big as the risk. And when the probability is high, you can swing or scalp. The probability is high for a scalp, not high for a swing. Buying here, it's a high probability trade for a scalp, not necessarily a high probability for a swing. And that's the same here. You know it's a high probability that it's going up for a scalp. You hope that it's going to go all the way up here. It's only a 40% probability that you're going to get a swing. Any entry is only a 40% probability of a swing trade. But many entries are a 60% probability of a scalp trade. Here's an example on the 5-minute E-mini chart. If your stop is 8 ticks away from your entry price, then your risk is 8 ticks. If the reward is 16 ticks or more, twice the size of the risk, I call that a swing trade. If the profit is less than 16 ticks, I call it a scalp. Here we have a double bottom in a bear trend. Pretty good buying here, and here, and you have a good buy signal bar. So let's say a trader buys here, betting on either a scalp, betting on a trading range or a bear flag, or possibly even a bull trend, a reversal. If he buys here, his stop is going to be below the buy signal bar, and in this particular case, it's 10 ticks below his entry price. He entered 1 tick above the high of that bull bar, and his stop is 1 tick below. If he exits here, he has 10 ticks profit, and that's 1 times his risk. That is a scalp. It's a high probability trade. I think this is certainly good enough for a scalp, but it's also a reasonable swing trade. If he exits here, 2 times his risk, I would call it a swing trade. And obviously, if he exited below here or below here, that would also be a swing trade. The minimum goal for a swing trader is at least twice his risk. When he buys here, he has a 60% chance of the market going here, and maybe a 40 or 50% chance of it going here, and probably less than a 40% chance of it going all the way up here. If it does, this is 3 or 4 times his risk. That is a great risk-reward ratio. So for example, if he exits here, a wedge 1, 2, 3, testing near the high, you have a bear bar, you have a second leg up, strong enough breakout here for at least a small second leg up, and now it's reversing down. If he exits below this bear bar, he gets filled here. This is 38 ticks profit. which is far more than twice his risk, and therefore buying here and exiting here is a swing trade, just like exiting here is a swing trade as well. This is a 5-minute chart of the British pound versus the dollar. Most forex traders don't refer to trades as swings or scalps. They call everything a trade. I use the term swings and scalps. Traders who do refer to trades as scalps are trading on 60-minute charts or smaller, and a scalp is between 10 and 50 pips. All other trades are simply trades. I usually distinguish swings and scalps because I tend to think of them differently. We have a pair of bull bars breaking out. We have a potential high in a trading range, or maybe there was a bear trend here, and maybe this is a bear flag. In either case, we're getting a pretty good breakout, a pair of big bull bars. It's reasonable to buy this close. It's a high probability buy for a scalp, and it's a reasonable buy for a swing trade. Swing trade, with a breakout like this, maybe 50% chance you'll get twice your risk, and maybe 40% chance you'll get more than twice your risk. If a trader exits here, he has 40 pips profit. Is it a scalp or is it a swing? If you're exiting here, I'd probably call it a scalp. You're exiting without any pullback, and you're exiting maybe around twice your risk, maybe less than twice your risk. If a trader exits here, he has 80 pips profit, which is clearly far more than twice his risk if his stop was here or here. And he sat through a pullback, another pullback attempt, and he has 2 legs up. Minimum goal for a swing trade is 10 bars and 2 legs. If you buy here, you have 1 leg, pullback, 2 leg, and you have more than 10 bars, and you have more than 50 pips profit. All of those things are enough for me to call that a swing trade. In this video, I talked about swing trading and scalping. A scalper is going for a quick profit. He's usually going to exit within 1 to 5 bars, and he does not want to allow more than simply a small pullback. A swing trader is going for a reward at least twice as big as the risk, and in general, he's looking for a trade that will last 20 or more bars. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on swing trading and scalping. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on swing trading and scalping. In this video, I want to focus on the importance of going for a reward that is at least twice as big as your risk when you're swing trading. For example, here's that British pound versus the dollar 5-minute chart. And you have a breakout bar here and a follow-through bar here. It's reasonable to buy that close. If your stop is 1 pip below the bottom of the breakout, you're risking 29 pips. If a reward is 60 pips or more, in other words, twice the risk, the trade is a swing trade. If you're going for a reward that is less than 60 pips, you can call it a scalp. Stop 1 pip below, and you bought that close. This is 1 times your risk. If you exit here, it's a scalp. Here's 2 times your risk. If you exit here, it's still a scalp. You did not allow a pullback. You exited on the first pullback, and you're going for a reward that is less than twice your risk. On the other hand, if you exited up here, possible parabolic wedge, 1, 2, 3, or 1, 2, 3, and you have a bear bar closing on its low after a small buy climax, you would be exiting with 80 pips profit. Your initial risk was 29 pips. 2 times your initial risk is 58 pips, and this is more than 58 pips, more than 2 times your risk. To me, that's a swing trade. Plus, you exited with 2 legs up, 1 pullback, 2. And you held on for more than 10 bars. You held on for about 20 bars. Most swing traders hope to get trades that last 20 or more bars, but their minimum goal is 10 bars and 2 legs. This is a 60-minute chart of the British pound versus the dollar. In general, on a 60-minute chart, if you're going for a trade that's less than 50 pips, I call it a scalp. On a 5 or 15-minute chart, I call a scalp anything that is between 10 and 40 pips. Anything more than that is a swing trade or simply a trade. Again, a swing trade has at least 10 bars and 2 legs. Usually, a trader is going for at least 20 bars. Here we have three very big bear trend bars, and you can call it a wedge, 1, 2, 3, at the top of a broad bull channel. You can also call it a wedge, 1, 2, 3, or 1, 2, 3. In any case, strong reversal down, and we're closing below a lot of bars. This is probably the start of a swing trade down. 3 consecutive big bear bars closing near their lows, strong bear breakout, good context. The odds are high that you're going to get at least a measured move down. High odds mean at least 60% chance that you'll get a measured move down. It's reasonable to sell that close, putting a stop above the top of the bear leg or above the top of this 3-bar sell climax, and you take profits down here. This is 90 pips below your entry price, and therefore it's a swing trade, or you could simply call it a trade. Also, it lasted more than 10 bars, and it had at least 2 legs, 1 pullback, 2. Scalpers hate pullbacks. Sometimes they'll hold through what they think will be a minor pullback, but in general, they don't want reversals. They don't want pullbacks. Let's say you buy here, around a 50% pullback of this buy climax, this breakout, 2 legs down, 1 pullback, 2. You can also call it a wedge. There's a bear bar, a doji bar, a big bear, a doji bar, and then another low here. Let's say the trader bought above the high of this bar, hoping for a wedge reversal up, and he put a stop just below. Very small risk, but you can call it a high 2 bull flag, a wedge bull flag. Whenever you're trading with a very small risk, you in general have a low probability of success. I think it's reasonable to take this buy for a scalp. The risk is very small. If you did buy above this bar, and got filled here, stop down here, you have dojis here, tight trading range. Maybe you'll allow the pullback, hoping for a little bit more up. Most bulls who did buy above this bar or above this bar will not exit. They'll probably either rely on a stop here or possibly a stop down here. The market got up and tested a prior lower high and reversed down below there. At this point, a lot of bulls will exit either below that bear bar or a second entry short below that bear bar because they'd be concerned about a double top lower high and a reversal down. The bulls who buy here, who did not exit here, now have a second reversal down. So low 1, low 2, and a bear bar. A lot of those bulls will exit here for a scalp. Another example, bear bar, bull bar, bear bar, bull bar. So 2 legs down, 1, 2. If you want, you can call it a high 2 bull flag, high 1, high 2, or 1 push down, 2 pushes down, high 2. You can even call it a wedge. 1 pullback, 2 pullback, 3. Doesn't matter. It's a tight trading range after a strong bull breakout. It's a reasonable buy. You have a good buy signal bar. You can buy above that high for a scalp, put a stop just below. You have a small pullback, but you're still in a tight trading range, and it did not hit your stop. Most bulls would hold long and rely on their stop. Maybe they hold long after this breakout, despite this pullback. A lot would exit below this second reversal down, but many would hold and get out up here. A big bull bar, a buy climax. And if you're looking for a quick profit, you're getting a gift, a big bull bar closing on its high and a new high. We have a strong bull breakout, and then a second leg, and then a third buy climax. So buy climax, buy climax, buy climax, buy climax, with 3 highs, possible parabolic wedge top, and you have a bear bar closing on its low. Some swing traders will take this short, others will wait until there's a strong bear breakout and then short. But it's reasonable to sell below that bear bar, and you get filled right here, and you put a stop above its high, a parabolic wedge top. Strong bear breakout with 2 bars. The second bar is the follow-through bar, confirming the bear breakout. The odds are now high that there'll be a second leg down. Traders will keep their stop above here. This is a major high that led to a strong bear reversal. Chances are, even if we rally like this, a couple legs up with decent bull bars, the market will get at least a small second leg sideways to down before it hits that stop. This pullback went above your entry price. Remember, you sold here, and the pullback went above your entry price, but it did not hit your stop. Most bears would continue to hold short. However, if you did sell here and you held short even though the market went above your entry price, and then you got another strong leg down, bears do not want the market to come back to their entry price a second time. Many bears would then move their stop to break even, or they'd simply put their stop above the top of this strong bear breakout because this is a major lower high. Traders do not want the market to come back to their entry price a second time after there's a second strong leg down. First leg down, second leg down. And you can see this reversal up did not get back to the entry price a second time. After the second leg down, traders either put their stop above the top of the bear leg, above the top of the sell climax, or even break even. Remember, a bear trend needs lower lows and lower highs. Lower highs are more important because bears exit if the market goes above a major lower high. If it goes above a major lower high, then they think the bear trend has ended and the market has either evolved into a trading range or possibly even reversed into a bull trend. Strong reversal up, high 2, bull flag, bull trend, first leg down, pull back, second leg down. So this is a high 2 bull flag, strong reversal up. Swing traders will hold short. A lot of them will hold short, relying on their stop, hoping that this is a broad bear channel that continues down much further. Strong bull breakout, but bad follow through. Strong bull breakout, bad follow through. This might be a broad bear channel. Usually, even though it's 3 pushes down, 1, 2, 3, and therefore a wedge bull flag, bull trend, wedge bull flag, with the bad follow through, we're probably going to get a trading range before an attempt at a bull trend resumption. 2 decent bull bars, bull bar closing on its high. It's reasonable to buy this for a possible swing up. We have a bull trend, a wedge bull flag, a bear channel, bull flag, and the sell-off is not all that strong. We have a pair of bear bars, but 5 or 6 bars up with a lot of bull bars. A bear bar and a follow-through bar, another bull bar. A pair of bear bars, dojis, and a big bull bar. This looks like it'll be a bear leg in a trading range or a bear leg that becomes a bull flag. Now we have a strong bear breakout that looks like it's failing. It went above this bull bar, and then we have a second entry buy. This is a reasonable buy for a wedge bull flag and possibly a swing up. Different ways to draw the wedge, 1, 2, 3, or 1, 2, 3. A little bit more than a 50% pullback. For the bulls who did buy here and who decided to hold for a swing, looking for a second leg up, leg 1, pullback, leg 2, some of them would hold and put a stop below the bottom of the bull trend, and they'd view this strong sell-off as simply a breakout test of the buy signal bar. Also a micro double bottom and a strong buy signal bar. If the bulls did buy here for a swing, this reversal down fell below their entry price. However, if there's a second strong breakout, the bulls do not want it to come back to their entry price a second time. Some bulls would exit on a second reversal down, leg 1, leg 2, betting that maybe we'll be in a trading range instead of a bull trend. Remember, this bear channel might be evolving into a trading range. It's big up, big down, big confusion, and chances are the market's going to go sideways. Trading ranges often have 2-legged moves, 1 pullback 2. It's reasonable for the bulls who bought here to exit below here, thinking that it might be simply 2 legs up in a trading range and the end of the rally. If a trader did not exit here, he probably would exit back at his entry price because we have a strong trend resumption up. He does not want the market to come back to his entry price a second time. This turned out to be a minor lower low, just a little bit below there, but you do not want the market to come back to your entry price a second time after it resumed up. If you do get stopped out, it's perfectly reasonable to buy again. Now we have a double bottom bull flag with a decent buy signal bar. However, most traders should get out when it hits the entry price a second time after the bull trend resumed. Again, if it comes back to your entry price a second time, the odds are you're going to be in a trading range and not a bull trend. And in a trading range, you want to be scalping, not swing trading. reasonable to get out here on the break below this low and the test of the original entry price. But if you did exit, as I said, it's reasonable to buy again above a good bull bar, because now you have a double bottom higher low, and possibly you'll get a breakout above the neckline and rally for a measured move up. So double bottom this low, and neckline here. The market sold off again, 3 legs down, 1, 2, 3. Does not matter that the market went to a new high after that first leg down. That's common when you have a bull trend transitioning either into a bear trend or a trading range. There's a transition period when the market is both in a bull trend, in other words, you can keep going higher, and in an early bear trend. So the bear trend often begins before the bull trend ends. 3 pushes down, 1, 2, 3. We have a micro double bottom. We tried to go up here, we went down, tried to go up again, and we have a bigger double bottom with this low. This is a support area. They bought here again. We're testing that price again. It's reasonable to take this buy. The buy signal bar is a doji bar, so it's not as strong as it could be, but it's still a potential wedge bull flag and a double bottom bull flag. Bear trend, bull breakout, double bottom, higher low, major trend reversal. You can also call it bull trend, bear reversal to a big double bottom, higher low, major trend reversal. You could also call it a big double bottom bull flag. You have a bull trend and then a pullback into a big double bottom, so it's a big high 2 buy. On a higher time frame chart, it could simply be a few bars down. On this time frame, it's 30 or 40 bars here, 30 bars here. Now we have 3 lows, 1, 2, 3, in a horizontal pattern, a trading range. It's also a triangle, and traders would buy this as a reversal up from the bottom of a triangle. Different computers see patterns differently. If there are many different patterns all with the same entry price, there's a higher probability that you'll have a profitable trade. Strong bull breakout. We have 4 or 5 consecutive bull bars, 2 of them big bull bars closing on their highs. Strong breakout of a bear channel. A bear channel is a bull flag, and we have a strong breakout. The market came back below the entry price. It's a breakout test, a test of the top of the buy signal bar, but it did not hit the stop. So traders are still holding long. Strong enough breakout. This is probably now a major higher low. Traders do not want the market to fall below this low. Also, they do not want the market to come back to their entry price a second time. You can see the bears tried to get it here, and it tried to get down to the entry price here. Both times failed. Many bulls after this rally would move their stop to break even, because if the trend is good, it should not come back to that entry price a second time. The bears tried to get a double top bear flag, tried to get a strong reversal down, and as strong as the reversal down was, it failed to hit the entry price, and you can see the bears giving up on this bar and the bulls becoming confident that we'd go up for at least a measured move. We have a double top and a neckline. Instead of breaking below the neckline and falling for a measured move down, we're breaking above the top. Traders expect at least a measured move up from the neckline to the double top and then up here. Small trend bar. Every trend bar is a breakout. Every trend bar is a climax. And here is a series of trend bars, a sell climax, climax, sell climax, sell climax, small sell climax, sell climax. You have consecutive sell climaxes, but on a higher time frame chart, for example, if this is a 5-minute chart, this is the 240-minute chart, here's that sell-off, here's this sell-off. It's simply a test of the bottom of a trading range. At this price level, the market reversed up here. It came down to the price level again, reversed up. It came down to that general area, reversed up. And this could simply be a sell vacuum test of support, where the bulls bought 3 times before. 1, 2, 3. On the 5-minute chart, this looks like a very strong bear trend. But it's consecutive sell climaxes, which usually result in a trading range or a reversal. And it's also at the bottom of a big trading range on a higher time frame chart. And if you want, you can call it a micro wedge. 3 pushes down, 1, pull back, 2, pullback, 3, and a larger wedge, 1, 2, and then 3. Second entry buy, first entry, second entry. It's a reasonable, aggressive buy for bulls looking for a swing up. If they buy above this bull bar, reasonable to put a stop below the low of this bear bar, betting that the support at the bottom of the 240-minute trading range will hold. Very tight bear channel, first reversal up minor, which usually means you'll enter a trading range either here or here. Higher probability to buy above this bull bar. We have a reversal up and now a higher low, probably going up for a second leg, and probably we'll get to the top of the most recent big sell climax, this high. Strong enough up here or here, the market's probably always in long. It still could be a lower high in a bear trend, but at this point, probably always in long. It's a complex rally. We have a pullback, we have a pullback, we have a pullback, and a pretty tight channel. Probably it's the first of two larger legs up. So leg one, a complex pullback, and then leg two. Scalpers are going to be pretty quick to take profits. For example, we have two legs up, one pullback, two. A scalper would get out here or here. 3 pushes up a wedge, 1, 2, 3, testing near the top of the sell climax. Scalpers would exit below that bear bar or below this bear bar and get filled here. That's because the probability of higher prices has fallen at this point. High probability here or here that we're going at least a little higher. But once we get the reversal down here or here, the probability is that we're probably going to go sideways. We might even reverse, but the probability has dropped, and therefore the premise of a scalp is no longer valid. A pair of strong bear bars, but possibly a higher low and possibly a 50% pullback. New bull trend, 50% pullback. The premise for swing traders looking for a second leg up is still valid, and swing traders would hold long even though we have a pair of consecutive bear bars. It's a breakout test of this high, and it's about a 50% pullback, and both bear bars have tails below, so they're not especially big. This body is smaller than that body, so the reversal down is losing momentum. In this video, I defined a swing trade as a trade where you're trying for a reward that is at least twice as big as your risk. The probability for a swing trade in general is at least 40%, and if you have a reward that is twice your risk as your goal, you have a positive trader's equation. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on swing trading and scalping. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on swing trading and scalping. Scalping is not for beginners. In fact, most professional profitable traders do not scalp much at all. They focus on swing trading. However, when a trader does scalp, he has to be aware of minimum scalp sizes. There's a realistic minimum scalp size, and you need to be aware of this. Most traders should always be looking for swing trades. Sometimes a swing trade turns into a scalp. Beginners should never look for scalps because it's very difficult to trade them profitably. You need a very high winning percentage, and that's just not realistic for a beginner. When a trader is scalping, it's usually easier to make money when you're trading with the trend. Beginners should never trade against a trend, even if the trend is weak. Bull trend, if you're going to scalp, it's easier to make money looking for buys. Here we have a small little bottom, a high 2, 1, 2. Strong breakout, tried to reverse down. We have a bull bar, resumption up. Now we have a pullback to a double bottom and a bull bar, buy above that. We have a high 2 buy, 1, 2, and it's a double bottom with that low and a higher low, a pullback from this breakout. And now we have a micro double bottom, a second entry buy, a tight trading range. You can look at it as a small triangle, a breakout, and a pullback. 2 legs down, 1 pullback, 2, so a high 2 bull flag, about a 50% pullback. These are all reasonably high probability trades, and they're reasonable scalps. Many very profitable traders who swing trade for the majority of their profit often will take scalps in addition to their swing trading. So, for example, in a bull trend, they'll be looking to buy pullbacks, sometimes scalping part, swinging part. When a beginner starts out, he thinks about only one thing: death. Death of his career, death of his dream as a trader. He is always focused on risk. And therefore he's drawn to scalps, because he knows that with a scalp, the stop can be tight, the risk is therefore small. However, he overlooks a very important variable, and that's probability. Unless you can structure a trade with a very high probability, you will lose when you scalp. Beginners are always looking at a trend as overdone, climactic. They're always seeing wedges, 1, 2, 3, 1, 2, 3. They're always looking for tops. They always want to believe that the trend cannot go much further, and because they're only focused on risk, they think, maybe if I sell a reversal, my stop will be tight, my risk will be small, and I can make some money. The problem is 80% of reversals fail, and therefore looking to sell reversals is a low probability trade. If you have low probability and low reward, you're going to lose money. For example, we have a wedge, 1, 2, 3, reversing down. We have a failed breakout above a wedge, reversing down. Here we have a lower high major trend reversal. Here we have a failed breakout above a double top. Here we have a final flag reversal. Here we have a wedge, 1, 2, 3. All of them look logical, except for one thing. It's a small pullback bull trend. The pullbacks are small, which means the reversals down are small, and in general, there's not enough room for a scalp if you're selling with a stop below bars. Some skilled traders might sell with limit orders above bars and scale in, but when you have a small pullback bull trend like this, it's better only to look to buy. On the next higher time frame chart, this entire trend is a strong breakout. The beginner sells below this bear bar, thinking, okay, I'm only risking here, my risk is small. However, small risk always means low probability. And if you have a low probability trade, you need a big reward. If you're scalping, you're going for a small reward. The trade that the beginner is setting up is just destined to fail. Even if he wins 50 or 60% of the time, his reward is going to be no bigger than his risk, and therefore he will lose money. It's a low probability strategy. It's doomed to fail. Every loss will be at least as big as each winner, and you probably will have more losers than winners, especially when you're trading against a very strong bull trend like this, looking to sell, and you'll bleed to death from 1,000 paper cuts. Each loss is small, but after you've had 3, 4, 5, or 6 of them, you end up with a pretty big loss. On the other hand, a strong bull trend like this, you should only look to buy. If there's a clear stairs pattern with good sized pullbacks, expert traders will trade against the trend, selling new highs. Here, that's not the case. We're getting gaps. Gaps mean small pullbacks, small reversals down, and it's very dangerous to trade against a trend that's in a tight channel, small pullbacks, and forming gaps. You should only look to buy. You buy the pullbacks, betting that the reversal attempts down will fail. This high, that low, a gap. This high, these low, a gap. A gap. This is a small pullback bull trend, and the pullbacks are not big enough for bears to make money, especially looking to sell with stops. When an expert trader looks at this, he sees a strong bull trend, and he's only looking to buy. He'll buy for any reason. He'll buy pullbacks. These are all examples of pullback buys. He'll buy below bear bars, betting the reversals down will fail. He'll sell bear closes, betting the reversals will fail. He'll buy at the market. Pullbacks are small. We're getting gaps. Small pullback bull trend, only look to buy. You can see the reversals down did not go below the breakout points. We're forming gaps. When you have a small pullback bull trend and it's getting gaps like this, you cannot make money selling. You might make money on some of the trades, but your losses will be greater than your wins and you will lose money. So even with a small risk, you're going to lose money selling. When there's a stairs pattern, you can make money trading against the trend. In a stairs pattern, a pullback goes above the breakout point. Here we have a reversal up, but did it get above the breakout point? No, we still have a gap, and the pullbacks are very small. This is a pretty good sized bar. It might tempt bulls and to begin to look for buys, But whenever you're getting gaps and the pullbacks are small, lasting only a bar or two, you cannot make money looking to buy. You should only look to sell. Some expert traders will take some scalps, sell scalps in addition to their swing scalps, but they'll only be trading in the direction of the trend. In this case, they'll be selling. Here, this pullback went above this breakout point, and therefore now we're in a stairs pattern. We're stair-stepping down, and the pullbacks are overlapping breakout points. When that's the case, expert bull scalpers will look to buy a new low, and they're willing to scale in, betting that the pullback from the breakout will rally back above the new low. Once they see a pullback going above the breakout point, and they see a weak rally like this, a weak sell-off like this, bear bar doji, bear bar bull bar, bear bar doji, this looks like a bear leg in a trading range, some expert traders will place a limit order to buy at that low, looking for a scalp. We went back above the breakout point. They'll do it again on the next leg down. They'll place a limit order to buy at that low. If it goes lower, they'll buy more lower, and they're looking for just a scalp. They buy, they take a scalp profit. They buy, they take a scalp profit. In general, they're going to be looking to exit somewhere in the middle of the prior bear leg, because that's where the bear traders will be selling. Whenever you're in a bear trend that's stair-stepping down, bears will look to sell around a 50% pullback from the last leg down. A scalp means a small profit. We're in a bear trend. We have consecutive bear bars here. A big bar, climactic, might not be much more down, but it's okay to sell the close looking for a scalp. And this would be your minimum scalp, maybe a couple points. You exit 2 points down from that close. When a trader sees this, he correctly assumes the market's going to go at least a little bit lower, and therefore he can sell for a scalp. 2 legs up, 1 pullback, 2, 50% pullback of this breakout. Traders will sell below that bear bar, at least for a scalp, knowing that this is fairly climactic. Maybe we'll enter a trading range. Maybe there's not much more down. We have a strong bull reversal, and the bar after it has a bull body. That is good follow-through buying, and therefore the odds are we'll go up at least a little bit higher. Bulls will buy that close, looking for a scalp. We have a 5th bull bar, but it's a 2nd follow-through bar, and the bears are trying to reverse down. A failed breakout above this high, a double top with the top of that sell climax. Chances are buyers below and at least a little bit more up. So traders will buy with a limit order at the low of that bull bar, and they'll get filled here, and they scalp out here. It looks easy, but the reality is most traders cannot do this. They'll make too many mistakes, and they'll end up losing money. If you can do it flawlessly, if you're an expert trader, sure, you can do this. But if you're starting out, this is not the way to trade. You'll make too many mistakes, and to make money, you need a very high probability of success, and that means you cannot make mistakes. Remember, a scalp, you're going for a small profit. Some traders will use wide stops and scale in. So for example, a bull might buy this low and put a stop down here, betting that either it's going to be the start of a bull trend or the start of a trading range. If it's the start of a trading range, we could get a very deep pullback, but it should stay above this low. He might buy for any reason up here, use a stop down here, and he's willing to scale in lower. If you use a very tight stop, then your risk is very small. Since your reward is also small, you need a very high probability of success, like a 90% probability of winning, and beginners simply cannot trade that well. Another problem with a tight stop is that the probability is not going to be very high. In general, the tighter the stop, the smaller the risk, the lower the probability. And that's a problem when you're scalping, because you need high probability to make money. Tight stops when you're scalping, in general, it's a bad idea. If you are scalping, it's better to use a wider stop and trade small enough so that you can scale in. That increases your probability, and it makes up for the low reward. I want to talk a little bit about what the realistic minimum profit target is when you're scalping. There is a realistic minimum size when you're scalping. If you scalp for a profit that's very, very small, commissions, slippage, mistakes will make it impossible to make money. I have several guidelines that I use to determine what's the smallest scalp I'll try to get in any particular market. For the E-mini and bond futures, I only scalp for at least 4 to 8 ticks. I'm trading in the Forex market, and I think a trade will probably make 5 or 6 pips. I will not take that trade if that's all I think it will make. I will only take the trade if I think there's a realistic chance of making 10 to 20 pips. For stocks and commodities, the smallest trade that I'll ever take is 10 to 20 ticks. I sometimes end up exiting with less than that, but I do not take a trade unless I plan on taking that much. If after I enter, I think my premise is wrong, I'll get out. And sometimes I'll get out with 2 or 3 ticks profit or 2 or 3 ticks loss. But as soon as I think my premise is wrong, I get out. Another guideline is, if I'm scalping, my minimum trade has to be at least 5 to 10% of an average day's range. For example, if I'm trading a Forex market and the average day's range is 100 pips, I do not want to be scalping for anything less than 10 pips. That's already my minimum for Forex markets as well. When I'm scalping on a 5-minute chart, for example, in the E-mini, the average bar is only 1 or 2 points tall. And I scalp for 1 or 2 points and I hold for 1 to 5 bars. Sometimes I'll hold longer. Sometimes I'll turn a scalp into a swing trade or part of the trade into a swing trade. But my general expectation when I'm scalping on a 5-minute E-mini chart is to get out with a 1 to 2 point profit, and I usually get out within 1 to 5 bars. Rarely, if you're trading the E-mini, you'll get a lot of bars that are 5 points tall or more. When that's the case, I'm not scalping for 1 point, I'm scalping for 5 points. I want to be scalping for about the size of the average bar. If the actual risk is small, if the bars are small and the legs are small, like on this particular day, I think scalping for 1 to 2 points is fine if you are a scalper. Most traders should not scalp. It'll be too hard to make money. It's certainly too hard to make money for a career, and you have to make sure that it's compatible with your personality. Will you enjoy it? If you don't enjoy it, don't do it. When you're looking at a chart and you're not sure what the minimum scalp size is, make sure that it is at least as big as the height of average recent bars and at least 5 to 10% as big as the average daily range. In this particular chart, the average bars are about 20 ticks tall, and the average daily range has been about 100 ticks. Here, a reasonable minimum scalp would therefore be about 10 ticks. In general, I prefer traders to lean toward more swing trading. You have 2 choices here. The recent bars are 20 ticks tall. 10% of the average daily range is 10 ticks. I think it's better to probably try to go for the larger of the 2 minimums, which is 20 ticks if you're looking to scalp this chart. Part of the reason for that is if the bars are 20 ticks tall, your stop is probably going to be at least 20 ticks away, and you want to be going for a reward that is at least as big as your risk. I have some exceptions. For example, in the E-mini, I usually scalp for 4 ticks unless the range is relatively big and the bars are relatively big, then I'll scalp for 2 points. In the NASDAQ, 2 to 4 points is a minimum scalp, and for the bond futures, 4 to 8 ticks is a minimum scalp. And it depends on how big the bars are. If the bars are bigger, you go for the bigger target. If the bars are smaller, you go for the smaller target. This is a 5-minute chart of the euro versus the dollar, and here are a couple scalps. Buying the reversal up, and here's a minimum scalp. A bull flag buying the breakout, here's a minimum scalp. If your son or daughter is in college, you know the minimum grade to graduate is a D. Would you be happy if your son proudly told you that his goal in life was to get a D or to make a minimum wage? Of course not. And the same is true with trading. Going for the minimum is rarely ever the best choice. Successful traders who take 10-pip scalps, they do it only when it's appropriate. And many days in the Forex markets, the markets are in fairly tight ranges, and if you're going to trade, the only way to make money is by scalping. Most traders should not trade when that is their only option. It's too hard to do it. Plus, most people do not have a personality that's compatible with scalping. They get stressed out. They feel too unhappy. This is very important. I've never met a trader who is making a living only going for minimum scalps. I know a lot of very profitable scalpers. I've met a lot of profitable scalpers over my 30 years. However, they do that as part of their overall plan, and they go for more than minimum scalps on most of their trades. In other words, they'll go for bigger scalps. So instead of 1 point in the E-mini, they'll go for 2 or 3 points. Instead of 10 pips in the Forex markets, they'll go for 20 or 30 pips, or they'll swing trade. You should never try to make a living only going for minimum scalps, because you will not succeed. I mentioned some of the problems with this earlier. There's a spread that you have to overcome. Some Forex brokers charge commissions. There's also slippage. And the mistakes become a real big problem. And everybody makes mistakes. Also, there are problems with the brokers and fills. The result is that you need to win 90% of the trades consistently for years if you're trying to make a living going for minimum scalps. There are traders who can do that, but you should assume that you are not one. It's a very rare trader who can do that and who is happy doing it. You need both. You have to be happy as a trader because you're trying to do this for a career, and your job has to be fun. Again, I know traders who win 90% of the time. That immediately tells you that they're scalpers. If you're winning 90% of the time, you have to be going for a low reward, because a high probability of success means a bad risk-reward ratio, and that means that you're scalping. You're going for very little reward. However, that does not mean they're going for minimum profits. For example, in the euro versus the dollar, they may be scalping, but they might be trying for 20 or 30 pips on their scalps. If you restrict yourself to only taking 10 pip scalps, you could theoretically be profitable. Paul Rotter was for many, many years, but it's unrealistic. Most people who try to make a living with simply 10 pip scalps will not be successful. Also, you have to be doing it successfully day after day, year after year, and you have to be happy doing it. I was an eye surgeon for many years, and I was very good at it, and I made a lot of money doing it, but I was not happy, so I stopped doing it. And if you're a scalper, it doesn't matter if you're very good at it. If you're not happy, you're not going to want to do it for the rest of your life. You not only have to be good, but you have to be happy. Very few traders have both of those things in their favor. I've been talking about the profit target, a scalp, and probability, but there's a third variable in the trader's equation, and that is risk. If you're trading a Forex market like the euro versus the dollar, you can usually use a 20 pip stop. But sometimes the bars are big and the swings are big. A 20 pip stop may not be reasonable. You have to win 90% or more of your trades to overcome the risk that you need to trade profitably, and that's just not realistic. It's possible, but very few traders can do it and can do it happily. When the bars are bigger, especially when there are a lot of reversals, a trader needs to use wider stops or win 90% of the time, otherwise he's going to lose. And since winning 90% of the time is very difficult to do, a scalper usually needs wider stops. And usually they have to scale in if they're going to be consistently profitable. If you cannot use the appropriate stop for whatever reason, if you're scared, if your account size is too small, just wait for a trade that would allow you to use the right stop. One of the problems going for minimum reward is when the bars are big, your risk is big, and even if you're winning 70% of the time, at the end of the day, you see your account is either break even or even losing money. And you're asking yourself, gosh, I won 70% of my trades today, and I did not make any money. And the problem is risk. If the risk is big and you're going for too small of a profit, that's the result. You're going to end up having a very difficult time making money. This is a 60-minute chart of the E-mini. The average bar on a 60-minute chart might be about 5 points. And therefore, if you're looking to scalp on a 60-minute chart, you should be going for about 5 points, and you should expect to exit within 1 to 5 bars. 5 bars on a 60-minute chart is 5 hours. It's still a scalp. Strong bull breakout and follow through. You can buy the close of the second big bull trend bar or the close of the bar afterwards. Place a limit order to get out with a 5-point profit, a stop below. Your reward is much smaller than your risk, but the probability of the market going up at least a little bit is high. We have a triangle. You can call it a wedge. 3 pushes down. 1, 2, or 2, and then 3. Trying to reverse up here. A triangle is a breakout mode situation, and that means there's only a 50% chance that a breakout will be successful. If you buy above the high of this bull bar, only a 50% chance it's going to go up high enough for you to make a profitable trade, and 50% chance it will not. It will either continue sideways or it will reverse. It looks like a good buy. A wedge, 1, 2, 3, 4, a good looking bull bar, a triangle, you're buying above its high, yet you lost immediately on the very next bar. On your entry bar, you lost. Now we have 2 consecutive bear bars, probably going lower. Scalpers will sell that close and look to scalp out. I call this bar a give-up bar. Well, this bar as well. It went below the low of this buy signal bar, and these 2 bars are caused by bulls giving up. And when you have trapped bulls like that, there's a 60% chance you'll get at least a small second leg down, and therefore selling this close is a high probability trade that you'll get at least a small profit, and therefore it's a high probability scalp. This is a 5-minute chart of the E-mini. Let's say you bought this close and you decided to exit with a 2-tick profit. High probability of making 2 ticks, and it's very high probability that you'll make 2 ticks. But what's the problem with that? One of the problems is commissions. Commissions in general are relatively small, but if the profit target is small as well, then the commissions can be relatively big. Let's say your broker charges you a $4 commission for a round turn, $2 to buy, $2 to sell. And then let's say you go for a 2-tick scalp. 2 ticks in the E-mini is a $25 profit. Here, you buy that close, you exit with 2 ticks, you made $25. But you had to pay a $4 commission, and therefore your net profit was $21. On the other hand, let's say you used a 2-tick stop, and the market went down and hit your stop before it hit your profit target. Instead of winning $25, you lose $25. You still have that $4 commission. So every time you lose $29. Every time you win $21. That reward is much smaller than your risk. How can you make money doing that? You need a really high winning percentage, well over 90%. And that's simply unrealistic. Let's say you took 10 trades and you won 60% of the time. Since you're winning $21 for every win on 2-tick scalps, your net profit would be $126. And you lost only 4 times, but you're losing $29 on each loss, and your total loss is $116 from your 4 losers. If you're right even 60% of the time, there's no margin for error. You're barely making a profit. You have to be right 80 to 90% of the time to make a living, and that's just unrealistic. Going for a 2-tick scalp is just not worth doing. You cannot do it profitably. And that's why I say there's a realistic minimum scalp size. And for the E-mini, the realistic minimum is 1 point, maybe 2 points. Here's a 60-minute chart of the euro versus the dollar. The average bar on the 60-minute chart is about 50 pips, and therefore a scalp is 50 pips or more. For example, if you buy this failed bear breakout, it's a higher low, and exit with 50 pips, you're exiting right here. And that's a good location. You're at the top of a possible trading range. For the bears, they see a double top at the top of a trading range, maybe a lower high versus this high. They have a strong bear breakout. They see this as a pullback from that strong bear breakout. Does not matter that this is a little bit above that. It's still a 2-legged pullback from this bear breakout. And you have a good bear bar, a low 2 short, low 1, low 2, either in a trading range or possibly in a bear trend, a double top, lower high. It might be the start of a bear trend. Some traders will sell below the low of that bear bar, and they'll get filled right here. If they're a scalper, they'll place a limit order to buy back their shorts 50 pips down, which is right here, a good location near the bottom of a possible trading range. A big bear breakout, probably going to get at least a couple legs down. Traders might sell below the low of that bull bar or below the low of this bear bar, a second entry short. and exit with a 50 pip profit down here. This is a 5-minute chart of the euro versus the dollar. And let's say you're thinking about scalping for 6 pips using 100,000 units. Some brokers charge commissions. All brokers require you to pay a bid-ask spread. Most of the time, the cost is relatively small. However, if the profit target is also small, like 6 pips, then the commission becomes relatively big. Suppose you're risking 6 pips to make 6 pips and you're trading 100,000 units. And let's say your broker has a bid-ask spread of 2 pips each way. Then you need an 8 pip move to make 6 pips. You need your 6 pips profit, and then you have 2 pips bid-ask spread buying and 2 pips bid-ask spread selling. And therefore you need an 8 pip move to make 6 pips. If you win on 6 of your 10 trades, each win is 6 pips times $10 a pip, you made $60. Each loser is 8 pips, not just 6 pips, because you have your 2 pip bid-ask spread buying and again selling. And that means your average loser is going to be about $80. The average winner is $60. And let's say you take 10 trades and you win 60% of the time, so you win 6 trades. Your average win is $6, so you make $360 from your winners, but your average loss is $80 times 4 losers, so you lost $320 from your losers. Even though you won 60% of the time, you lost money. There's no margin for mistakes when you're going for a reward that's too small. You need a success rate of 90% to make a living, and that's unrealistic. Plus, you have to be happy, and that's very hard to do. And therefore, there is a minimum scalp size, and you should never be scalping for less than 10 pips, preferably less than 20 pips. And most traders should not be scalping for a living. They should be swing trading. Sometimes the market is very quiet, and the only way to make money that in a particular day is to scalp, and that's okay. It's important to understand that scalping is not for beginners. In fact, most traders should swing trade and rarely scalp. If a trader does scalp, he should not scalp for a size that's too small. Otherwise, the cost of commission, slippage, and spreads and mistakes become too great, and it becomes impossible to profitably trade unless you win 90% or more of your trades, and that's simply unrealistic. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on swing trading and scalping. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on swing trading and scalping. Sometimes traders will take a trade as a swing, and because of the way the price action is unfolding, they'll convert it to a scalp. One of the highest probability trades that a trader can take is entering during a strong breakout, betting that the breakout will continue. Therefore, the math is okay to scalp in a strong breakout. A very bad thing to do is take a trade as a scalp, and then it starts to go against you, and you decide to convert it into a swing. That is a losing strategy. You're going for a small reward, yet you're willing to accept an increasing loss, so much so that you need an extremely high winning percentage to make the strategy profitable. Every new tick that comes on every chart gives you new information. If you enter a trade for one reason, and then the information makes you think that your premise is no longer good, you have to make a change in what you're doing. For example, we have a strong bear trend. It's a sell to close strong bear breakout at this point, and you have a low one short. We have a pullback in a bear trend where the market sold off for about 10 bars without a bull body. However, 2 consecutive dojis, trading range price action, and consecutive sell climaxes all the way down. There, here, a little bit here, these 2 bars, and then this entire sell-off is a big breakout bar on a higher time frame chart. And it's a big sell climax late in a bear trend, breaking below the bottom of a bear channel. Chances are the market's going to reverse soon. This is a low probability short, and therefore only a swing. You're betting that an oversold market is going to get a lot more oversold. Chances are it will not. Whenever you take a trade that does not have a very high probability of success, You have to be swing trading because you need a big reward to offset the low probability. This is not a good scalp, selling below that bear bar. Here we have another big bear bar. In fact, this is the biggest bear bar in 20 or 30 bars. Whenever you have the biggest bear bar coming in a bear trend after the trend has lasted 20 bars or more, it's more likely an exhaustive end of the trend rather than a measuring gap leading to an accelerated trend down. When a trend ends, it converts either into a trading range or into an opposite trend. This is a high probability bar, indicating that the trend will either end here or very soon. It's a probable exhaustion gap. The gap, once this bar closes, is between the close of this bar and the breakout point, this low. High probability that that gap is going to close soon, and in fact, it closed 2 bars later. Had you taken this short as a swing short, and then you see this big bear bar late in a bear trend, you have to be thinking, uh-oh, this might be the end of the trend and not the start of a new leg down. And then you get a bull bar reversing, closing near its high. A swing trader should exit above this bull bar because the premise of a continued bear trend is probably very low probability at this point. Probably the best the bears get is sideways for 5 or 10 bars. Did he make a profit? He might have made a very small profit. He converted his swing trade entering here into a scalp entering here. We're now in a bull swing, but it's the first strong breakout above a bear channel. This rally is probably a minor reversal, and it probably is going to convert into a trading range fairly soon. If you want, you can call this a triangle. We have a pair of small dojis after a big bull bar and after a down bar here. First push down, second push down, and then third push down. On a smaller time frame chart, this is a triangle, and it's occurring fairly late in a rally, and this rally is probably going to be a bull leg in a trading range because it's the first breakout of a very tight bear channel. The reversal up is probably minor, and then once it pulls back, the bulls can get a higher low major trend reversal. Since this is part of a minor reversal, it probably is not going to go up all that much higher. Relatively low bet for a swing up. Since the first leg up after a very tight bear channel is probably a bull leg in a trading range, and then you suddenly get a very big bar, 15 or more bars into the range, you have to be thinking of this as possibly a second leg trap. It's not really a second leg, unless you call this whole thing first leg, pullback, second leg. You can call it a parabolic wedge, 1, 2, 3, but a very big bull bar, late in a bull leg in what is probably going to be a trading range, probably a climactic end to the bull leg. Also, it's testing near the top of the bear leg. That is a logical resistance area and a good place for bulls to take profits and for bears to start to look for shorts. You have a big bear reversal bar closing on its low. Now you have big up, big down, a triangle late in a trend, probable final flag. Most swing traders who bought above here should exit at this point. Big up, big down, probably big confusion in a trading range. Also, you're near the top of a trading range, and this is probably a bull leg in a trading range, which means you're probably going to get a bear leg in a range. Once you see this reversal, traders should exit their swing below that low. They'll have made a profit from here to here. It'll be small. They began taking a swing trade, hoping that this would be the start of a bull trend, even though it probably would have to form a major trend reversal before you could get a bull trend. Low probability swing buy. And most bulls who took that swing trade would get out right here below that bear bar, converting their swing into a scalp. Anytime you take any kind of a trade, swing or scalp, after you enter, if the premise is no longer valid, if the trade is unfolding in a way that's not consistent with what you were expecting, you simply get out, even if it's for a loss. 4 consecutive bear bars closing on or near their lows. Some traders would sell this bar, even though it's a breakout and not a follow-through bar after the breakout. But some traders will take a chance. They'll sell here and put a stop above the top of the bear leg. I usually wait. If I did not sell earlier, I usually wait for a follow-through bar. In other words, another bear bar closing near its low. And here, instead of a bear follow-through bar, we have a bull follow-through bar. That makes a bear trend less likely and a pullback into at least a trading range or possibly a bull trend more likely. That is bad follow-through after a bear breakout below our trading range or a prior low. The bears who sold this close, their stop is above the top of the bear leg or maybe above the top of the sell climax, the 4 consecutive bear bars. bad follow through, a bull bar, a doji bar, another bull bar. The bears who took this short are thinking, uh-oh, this might be a trap and a failed breakout, and it could quickly lead to a reversal up. Most bears would probably exit above this bull bar. Others would exit maybe above the top of this doji bar, that doji bar, or this second bull bar. And you can see when it went above the second bull bar, it started to accelerate upward. This pair of bars is a sign that the final bears are giving up. Whenever a trade goes against you, but you think your premise is still valid, you can scale in and simply rely on a logical stop. We have a strong bull breakout after a failed bear breakout. Just like the bears sold this close, the bulls will buy that close, or they'll wait for another bull bar and buy the close of that second bull bar. They have it here. Even though it has a big tail on top, you have trapped bears who are looking for any kind of a sell-off so they can get out with a smaller loss. You'll have bulls who did not buy the reversal up, and they're hoping for any kind of a pullback so that they can buy. Buying up here, you're betting on either a bull trend or a trading range. If it's a trading range, it'll sell off and it'll come back up to the top of the range. This is a high probability trade. Buying this close has a high probability of either making a profit or avoiding a loss if you can scale in lower. You buy that close, you put a stop below the bottom of the bull swing, and then you're disappointed by the follow through. 1 bear bar, 2 bear bars, 3 bear bars. Maybe it's going to reverse down just like this bear breakout reversed up. More likely, after a failed bear breakout and a strong bull breakout, the best the bears will get is a trading range for 5 or 10 bars. And therefore, the bulls who bought up here can hold through these bear bars, betting that the market will come back up to that high close where they bought before it gets down to their stop below the bottom of the bull swing. These bulls might add on at a scalp lower. For example, if this is a 5-minute Forex chart, they might add on 10 pips lower. If it's an E-mini chart, they might add on 1 or 2 points lower. They always want to add on at least as big as a scalp below because they're trying to get out, break even on their first entry if the market gets back to their first entry, and they want to make a scalper's profit on their second entry. Many bulls will look to enter above a bull bar. We have a doji here, not particularly strong, but they might enter above this bar, no fill, or they might enter above this bar. We have an III and a bull bar closing on its high. If this entry point above the high of this small bull bar is at least as big as a scalp below this close, it's a reasonable entry, betting that we'll come back to that close at a minimum. And you can see what happened. Bulls bought this close. They did not like this. They decided they wanted to get out break even if the market got back to their close. And some of them will add on here as long as the distance between this and that is at least as big as a scalp. And what happened when we got back to that close? It went a little bit above, and that allowed these bulls to exit with a limit order break even. And if they bought more here, then they made a scalp profit when the market went back slightly above their first price. The bulls who bought here, they were using a swing stop. Whether or not they were scalping or swing trading, it's high probability that they would make money or not lose money, so it's okay to scalp. And they got a scalp on their second entry, and they got out break even on their first. As long as the breakout is continuing, you can repeat the process. You can use a swing stop and scale in if the market goes against you. If you sell anywhere in here, your stop is up here. It does not matter if you sell that close or below this bull bar, even selling below this bear bar. The stop for all of those trades is up here. Let's say you happen to sell right down here, the lowest close of the entire sell-off. When you're taking that short, you don't know that it's the final bear bar, but you soon discover that it is. Mathematically, it's still a reasonable thing to do. We have consecutive sell climaxes, bear bar here, then 3 bear bars, a sell climax, and then 2 bear bars, a sell climax. But a fairly big bear bar, possible 1 bar final flag, and a tail, probably going to get a pullback in a trading range soon. The math is still okay to sell that close because the first reversal up from a tight bear channel probably is going to be either a bull leg in a trading range or it'll be a bull channel that becomes a bear flag. In other words, the odds are whatever rally we get will come back down and test this close before it gets up to that swing stop. Therefore, some traders will sell this close and look to sell more higher and put a stop up here. Scale-in traders have to trade small because whatever risk they have, it has to be no greater than the risk on any other trade. And if they enter a second time or even a third time, the total risk from all three entries has to be no greater than the risk on any other trade. So they have to trade small. The stop is far away and they're adding to a position. Some traders who sold this close would look to sell more, maybe 2 points higher, and they would get filled right here. They would keep their stop here above the top of the bear swing. It's a swing stop, but they're confident that the first reversal up would be minor, becoming either a bull channel, bear flag, in which case they would expect a sell-off back down to test that close, or it could simply be a bull leg in a trading range. Trading range, you get a leg up, you expect a leg down back to that close. Look what happened here. The trader sold here. He sold more 2 points higher. He placed a limit order to get out at that low close. The market hit his order. Most traders would not be filled. And then we get a bull bar closing on its high. Traders at this point would assume that these sell the close bears are trapped and they're going to buy back their shorts. You can see this big bull trend bar. It's a give up bar. Traders who are aware of what's going on, traders selling this close, disappointed by the bull bar, selling more higher, trying to get out, break even on their first entry, and with a scalp profit on their second. Most of them did not get out with a profit. They exited above here, around break even on their second entry and with a small loss on their first entry. Other traders would see that and say, well, it's still probably a minor reversal up. This is not enough bars up, not enough bars down for this to be a major trend reversal. It's therefore a minor trend reversal as long as we stay below the top of the most recent major lower high, the top of this bear breakout. And therefore, they'll add on again. For example, they might add on 2 points above their second entry, and they'd get filled here, or they would sell on a reversal down below a bear bar, and they'd get filled right here. It's a big low two short. One leg up, there's the low one, second leg up, and then this is the low two. It's also around a 50% pullback and what could end up being a bear channel, a reasonable location for bears to sell. The swing down tested the low close, and they get out break even on their first entry, 2 points profit on their second entry, 4 points profit on their third entry. But again, they only take that trade if they're trading small enough so that the entire risk from all three entries is no more than they would have on any other trade. When you're entering during a strong breakout, in the direction of the breakout, you have a high probability of making money. And therefore, it's reasonable to scalp if you can make the decisions fast enough. When there's a strong bear breakout, the probability of the market moving down X number of ticks before it goes up X number of ticks is between 60 and 80%. X can be any size, 2 ticks, 5 ticks, 15 ticks, 27 ticks. Strong bear breakout, good follow through. If you sell this close, there's at least a 60% chance that the market will fall X number of ticks before it goes up X number of ticks. You pick the number. 5 ticks, probably will fall 5 ticks before it goes up 5 ticks. 10 ticks, probably will fall 10 ticks before it goes up 10 ticks. It's a high probability sell. At least a 60% chance of a measured move based upon the height of the breakout, the open of this first bar, the close of that final bar. Let's say you were using a 2-point stop. Strong momentum down, strong breakout, 60% chance the market will fall 2 points before it rallies 2 points. Reward equal to risk, but probability 60% because of the strength of the bear breakout. Therefore, it's a reasonable trader's equation to exit with the reward equal to your risk. You sell that close, and if you want to use a 2-point stop, your stop is right there. You can place a limit order to get out with a 2-point profit, which would be right here. Here's a 60-minute chart of the euro versus the dollar. In a strong bull breakout, the probability of making X pips up before X pips down is between 60 and 80%. It doesn't matter what X pips are. It could be X could be 5 pips. So the probability of making 5 pips before losing 5 pips is at least 60%. The probability of making 29 pips before losing 29 pips, at least 60%. Therefore, the risk equals the reward, but the probability is high, 60% or greater, this trade has a good trader's equation, and it's a good strategy. Here we have a very big bull bar breaking out of a trading range, bull trend resumption, bull trend, trading range, 2 legs down, 1 pullback 2, and now we're clearly breaking to the upside, and we have a follow-through bar. When you have a strong breakout, close above the high of the past 30 bars, and then you have a strong follow-through bar, there's a 60% chance the market is going to rally for a measured move based upon the size of the breakout. For example, from the open of the first bar to the close of the final bar. The breakout grew here and it grew here. If you entered here, there's a 60% chance it would go for a measured move from this open to that close before it fell below this low. Good strategy to buy the close of that follow-through bar. Let's say you wanted to risk 50 pips and go for a profit target of 50 pips. You buy that close, you place a stop 50 pips below. There's a 60% chance it'll go up 50 pips before it goes down 50 pips. You can place a limit order to take profits 50 pips above, and you can see the high of this bar is slightly above that limit order, and you would have been filled right here. You would exit with a 50 pip profit. I would call that a scalp on the 60-minute chart. You held for only a couple bars, a few bars, and you did not allow any pullbacks. This is obviously a strong bull trend in the E-mini, a 5-minute chart. You can see gaps and negative gaps. This high, this low, this high, these lows, this high, these lows. It's a small pullback bull trend. Chances are it's going to continue a long time. Always in direction is clear. Probability is high enough so you can scalp repeatedly instead of swing trading. For example, a bull scalper can keep buying for any reason and repeatedly take 1 to 2 points profit. He could buy below a bear reversal bar. He could buy a bear close, betting that the bear reversal attempt will fail. He can buy above a bull bar, betting on trend resumption. We have a bull flag, a triangle, a bull breakout, a pullback, high 2 pullback, high 1, high 2. You can buy that. You can buy at the market. You can buy for any reason and keep trailing your stop below the most recent major high or low. A bull breakout here, maybe you put your stop down here. If you buy anywhere in here, you have a new breakout to a new high with a couple strong bull bars. If this is going to continue as a small pullback bull trend, it should not fall below this low. So if you buy at any point, even if you bought down here, after you've had this leg up, traders can raise their stop to right here. You could buy and take a point or two profit and just buy repeatedly, taking 1 or 2 points profit. And you can see there are at least 10 reasonable buy scalps. In fact, there are probably 20 or 30 good buy scalps during this bull trend. So you can buy, exit, buy, take profit, buy, take profit, buy, take profit. However, as simple as that sounds, it's very hard to do because a lot of times you'll exit and then you'll need to take a break, an emotional break for several bars, and then you will not re-enter. You'll start thinking that maybe it'll pull back and you'll get a deeper pullback, maybe it'll reverse. Most traders cannot keep entering and taking profits, entering and taking profits. You end up missing too many trades. Strong bull breakout, 4 big bull bars closing on their highs. It's much more profitable and much more reliably profitable to buy and hold on as long as the premise of a strong bull trend is valid. For example, you buy above this bull bar and you hold to the end of the day, and you have a bear bar closing on its low, betting that the market will have some profit taking into the close. You're going to make far more money buying here and exiting there than buying and exiting repeatedly on the way up. This is a 5-minute chart of the euro versus the dollar. Very strong bear trend. So a trader can sell at any point and scalp if he wants. High probability of making money if you're scalping. And you can do it repeatedly. The direction is clearly down and we're probably going lower. Therefore, high probability of making a reward at least as big as your risk, wherever your risk is. A bear scalper could keep selling, taking 20 pips profit, and then selling again and do that all day long. We have a bear breakout, a follow-through bar, sell the close. A bull bar, so a pullback, sell below the bear bar. We have another pullback, sell below the bear bar. A little inside bar, sell below its low. You can sell the high of this bull bar, betting the reversal up will fail. We have a bigger pullback here, you sell below the bear bar, or you take the second entry short below this bear bar. Many, many opportunities to scalp here, each one for 20 pips. However, most traders cannot keep entering and taking profits. They'll end up not entering again often enough, and they'll end up missing too many good trades. Here we have a strong bear breakout and a follow-through bar below a tight trading range. a reasonable short, maybe on the close of that bar. There's no good reason to get out anywhere through here. Maybe here, the biggest bear breakout late in a bear trend, probably an exhaustive end of the trend, micro double bottom, a bull bar closing on its high, reasonable location to take profits, final profits, or maybe here when we're starting to enter a triangle. So a trader selling here and just holding through all of this made a lot of pips, probably a lot more than the scalper who tried to sell, take profits, sell, take profits, sell, take profits. Sometimes traders get a surprisingly quick, big profit. Oftentimes when you're swing trading, the stop is very far from the current price, and therefore the risk is very big compared to the remaining reward. When that's the case, you have to be careful about managing your trade. We have a bear swing and a bear flag, yet we get a bull breakout. We have a pullback from that breakout. Probably we're going to get at least a small second leg up. This might end up as a trading range. We might test to the top of the range. It's reasonable to buy on a stop above that bear bar, looking for at least a small second leg up. Stop below the bottom of the bear leg if you're taking that buy. And a measured move up from the bottom of the bear trend to the top of this leg up takes you right here. And you can see what happened when the market reached a measured move target. A lot of selling. It's also a breakout above this lower high, the top of the bear swing, and you always have some selling there. You'll have bears exiting with stops. You'll have the bulls who bought here looking at this as a gift, a surprisingly quick, big profit, and they'll take profits at or above a prior high. You'll have other bears who will look at this as a potential trading range, big down, big up, big confusion, trading range likely. They'll place limit orders to sell here. So lots of reasons to sell around that prior high. Whenever a trader is buying for a swing and the market quickly reaches a logical target, it's perfectly fine to exit, even if it's on the same bar. Is that a swing or a scalp? Well, you got a swing size profit, but in a scalp time frame. The very same bar in which you entered, you took profits. One of the terrible things that beginners sometimes do is they take a trade for a scalp, it does not go their way, it starts to go against them, and they decide to convert the scalp into a swing. That is a losing strategy. This is a 5-minute chart of the E-mini. It's really impossible for most traders to scalp repeatedly in a trend. It's okay to look for really great setups and use big volume, and you can theoretically make a living doing that. Most professional traders, even those who scalp most of the time, swing as much as they can because they know that it's very difficult to make money simply scalping alone. You have to swing trade at least part of the time. I have a video in this series on extreme scalping, and I talk more about how to scalp repeatedly. If you have a great setup, don't scalp because it's probably going to end up being a swing trade. Great setups do not happen often, but when they do happen, you have to be aware that you have a great setup in front of you. Look at this. We have a bear trend. We have a bull reversal attempt. It failed. We're trying to reverse up again here. Strong enough breakout to the downside, probably at least a small second leg down. Maybe this is the second leg down, but not a good buy signal bar, so a lot of traders will not buy that. But again, we have another strong reversal up just like we had here. We have another attempt down by the bears and another reversal bar, and this bar is closing on its high. This is a third entry buy. It's a small expanding triangle, too small to call this a major trend reversal. However, it could be a trading range bottom that could lead to a reversal up. This is a high probability trade for at least a scalp. And if you're taking this for a scalp, it's better to be aware that this could be the end of a leg down, and we could easily test the top of the sell climax. And therefore, if you're looking for a scalp, I would not be too quick to take profits. I would consider swinging at least part of the trade. The math, it's okay for scalping. You buy above the high of this bar, you get filled early on during this big bull trend bar, and you could scalp for 2 points, risking 2 points. The probability is high that you'll make your 2 points. The math is acceptable for a scalp. However, if you're thinking about a possible swing trade and you do not exit here, you wait for a logical end to the trend. Is this a logical end to the trend? Probably not. What about this? Well, you got 5 bars up without a bear body, and you got a very tight bull channel. Probably the first reversal down will be minor, and we'll get at least a little bit more up. Strong bull breakout here, at least one more leg up. Maybe this is the one more leg up. We're getting near the top of the bear trend. It could be converting into a trading range, big down, big up trading range. This is a reasonable place for traders to exit. If he bought here and he exited here, he took about 10 points profit, and that's better than 5 2-point scalps. The trader who bought here and took the 2-point scalp misunderstood that this could lead to a pretty good reversal up, a swing up, maybe a swing down for a couple hours, swing up for a couple hours. This is a good setup for a swing up. And in general, it's better not to be too quick to take profits and try to swing at least part of your trade. One of the biggest reasons for beginners losing money is that they confuse swing trades with scalp trades. They mix up swing and scalp entries and exit. For example, if you take a swing trade, manage it as a swing trade. Don't scalp. A small expanding triangle, consecutive sell climaxes here, here, here. A good-looking buy signal bar, bull bar closing on its high, bull follow-through bar, bull bar closing on its high. This is a reasonably good swing setup. If you bought thinking, oh wow, what a great possibility for a swing trade, maybe we'll test here, maybe we'll test here. Don't scalp for 2 points profit. If you entered thinking that it was a reasonable swing trade, don't convert it into a scalp. If you're buying this for a swing trade, manage it like a swing trade and you exit up here when the probability of higher prices becomes much less. Another big problem with beginners is they think they're taking a scalp and then they decide to manage it like a swing trade. That is a losing strategy. If you take a trade planning to scalp, rely on a scalp stop and don't pretend it's now a swing trade. Here we have a small pullback after a buy climax. Traders should expect at least a little bit more up, but we're getting near the top of the bear trend. Big down, big up, big confusion, probably going sideways soon. And look at the number of small doji bars since the market had this first pullback. This looks like a bull leg in a trading range. If you're buying up here, you might be buying pretty close to the top of that range. This is a buy climax late in a bull trend, probably going to be an exhaustion gap, and the market will probably pull back below the breakout point and below the bottom of the buy climax. Buying up here, low probability bet that you're going to get much higher prices. 3 pushes up, 1, 2, 3. Nested wedge, 1, 2, 3. There are many firms out there that specialize in high frequency trading, and they do it using computer algorithms. There are a few traders, very successful, profitable scalpers, who manually do high frequency trading. High frequency trading is a type of scalp. You're looking for a small profit. Usually your risk is not all that big, and you need a high probability of success to do it profitably. Computers can take every signal and manage the trades perfectly. For example, these are all reasonable scalps. Small bear flag, sell the close, sell the close, sell the reversal up, betting it'll be either a bull leg in a trading range or a bear flag, sell the reversal down, same thing here. A strong bull bar in a tight bear channel, first reversal up will probably fail. We have a sell off, a second close, sell it. Here we have a bear bar after a buy climax, disappointing bar. Probably will pull back at least a little bit more. The bulls will probably need at least a micro double bottom before they buy. Here we have a second leg up. We're getting fairly high up in the range. We have a breakout above the top of the sell climax. Bears will sell again. Bulls will take profits. Here we have a bull flag, but it's a doji after a buy climax. Low probability buy. Therefore, traders will sell. You have a high 2 buy, but a bear doji probably at least a little bit more down. We have a bull breakout, a second leg up in a bear bar. Sell the reversal down. Here we have probably a lower high major trend reversal, a weak rally, small bars, probably going at least a little bit more down. All are reasonable scalps. Many buy scalps as well. You buy the reversal up, you buy closes, you buy below that bull bar, betting that the bear reversal will fail. Here we have a micro double top, up here, down here, up here. Probably going to get at least a second leg up from this strong rally. So traders will buy that low, they'll buy the bear close, they'll buy above this bar, a high 2 buy, high 1 above this bar, high 2 here. Here we got a wedge bull flag, 3 pushes down, 1, 2, and then 3 or 4. You have a bull inside bar, a higher high double bottom. You got a bull breakout of the wedge bull flag. You have a pullback. Here you got a small bull flag. Here you got a micro double bottom and a higher low. All of these are reasonable scalps, and computers can take all of them. and a really good trader can take all or most of them. But very few traders can do that, and many who can do not want to do it because it's not fun for them. It's very difficult for people to do this profitably and for the long term. Therefore, traders should not be looking for manual, high-frequency type of scalps. In this video, I talked about how you can enter a trade as a swing, but then as the trade unfolds, you decide it's no longer a valid swing and you could scalp out. When there's a strong breakout, the probability of the market continuing is high, and therefore traders can scalp. In any high probability situation, traders can scalp. Finally, if you manage a scalp like a swing, you're going to lose money. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on swing trading and scalping.